What's up? So I've been putting together a little bit of background and research to kind of help people with this idea of where we're at and how likely it is we're going to come out of these lows. And unfortunately, the answer isn't as easy as it used to be because we're transitioning away from this old framework that we used to have. You'll recognize the old framework when we would get in trouble. The Fed would cut. That's one thing they would do. They would lower interest rates. They would ease liquidity. And generally, when we fell, it was because of some economic event. We would get bad job numbers, bad CPI, maybe a lowered GDP forecast, something like that, and we would fall off. And they'd say, "Oh no, recession fears. We got to do something to prop up the economy and keep us out of a recession." And the Fed would cut and ease rates and or ease monetary policy, and we would come back out of it again. When we go back and look at some of the specific sell-offs that we've had over the years, some of them wasn't even because of something happened in the US. It was something happening somewhere else in the world. Like this last one, August in 2024, that was because of Japan. The carry trade unwind, and then it spiked and caught short VIX traders, and then we had a short squeeze, and we just had this carry trade unwind mess. But it got resolved really fast. If we go back and look at the downturn that we had, say in the 2022 bear market, uh, inflation was out of control. The Fed said they were going to have to get that under control, and they didn't care if it wrecked the economy to do it. They didn't care if it was going to put us into a recession. And so the market accepted that, and they raised rates, and we sold off until they started to get things under control. So that's the normal way of doing things. But we have a new administration, and we have new goals and new mandates. The expectation is that we're going to transition away from this economy that is propped up by government spending, and instead will become an economy that is built on private sector labor. This is really going to mess people up. It's messing up the GDP forecasts. It's messing with inflation expectations, share buyback programs, earnings forecasts and estimates, projected unemployment rates. All of that is being revised. And so they said they're going to shrink government and lay off a bunch of people, fire a bunch of people out of the government. That's going to increase the unemployment rate. They don't have anywhere to go. Companies are giving forward outlooks that say, we don't know. The tariffs are a big threat, and we don't know how that's going to impact our company, so we can't give a forward guidance. And they're already starting to do layoffs. They're not going to hire a bunch of people from the government who got laid off. So we're normally the shining light around the world when it comes to money being invested in the markets. People want stability. They want assurances of a continued buoyant economic backdrop. And we've got institutions downgrading US markets and upgrading markets like China. So Citigroup put out their rating and upgraded China to buy or overweight or whatever word you want to use there. I believe it was uh, overweight, and they downgraded US as a hold or sell rating to be holding less S&P or less US markets and holding more China markets. And that's just one, that's just Citigroup, but it won't stop there. So companies that are invested or investors that are in the US markets, they're going home. They're taking their money, they're going back to their country of origin, and money follows money. So the more these people leave, if Europe money goes back to Europe, China money goes back to China, they're not holding US bonds, they're not trading in US markets, and then investors around the world follow that money into those places that are doing better. And we get this sort of sell off. It's not much of a surprise, right? Now, we don't have all of the numbers because this current quarter isn't done yet. And I'm going to show you guys some charts with what we do have, but there are missing data points because, well, this quarter isn't done. The tariff talks are also a really big part of it, right? Just the threat of tariffs keeps the unknown in place. And then the current headlines, hey, we're going to put them on. Nah, just kidding. We're going to take them off. Maybe. Kinda. We'll reevaluate next month. It's not providing that calm, consistent marketplace, and we won't get it anytime soon. We run the risk of disinflation, deflation. We run the risk of a recession, 100%. That is on the table. And while we can expect some assistance from the Fed, because they're not going to just close their eyes and walk away, it'll be much less, and it won't be with a goal to bring us out of that recession. It'll just be with the goal of not completely crashing and burning the entire system. So we can't expect the Fed to come in and, keep the plane flying, so to speak. They last year and a year and a half ago, they were talking about, well, maybe it'll be a soft landing, maybe it'll be a hard landing. No, heck, we ain't even going to land at all. We're just going to keep on going. I would expect the plane to land, probably a little hard, and it's very likely we go into a mild recession. But for how long, we don't know because we don't have the new framework in place. We don't even know what the new framework is going to look like. So we've got slowing economic forecasts causing GDP revisions, inflation expectations continuing to stay elevated, and we have wait and see and forward guidance from corporations along with the tariffs. Money's not coming back here anytime soon. And when you lose investor confidence, you don't just get it back by flipping the switch. It's going to take time to bring that money back. So we're in a pickle, Could we bounce? Oh, yeah, it's almost guaranteed, right? Price is going to behave the way it's supposed to. So we'll get a bounce, we'll rally back. It likely won't be able to make it back to previous highs. I'd be surprised if we even get halfway back. And then we're going to head back down again. I don't necessarily think that we're just going to fall. I don't think it's going to be like that. But there is no path back out again anytime soon. And all of the biggest names that we had carrying us, like the Mag 7, the hyperscalers, all connected to NVIDIA and CapEx, yeah, that's gone. Now they're promoting China as having the new Mag 7 and the new hyperscalers, lifting up, JD, Baba and Baidu as chip developers and developing new foundries. I mean, maybe not, probably not, right? But their markets are way cheap compared to ours right now. If anybody wants to invest in the Mag 7, you got to hold your nose, buy it at the highs, right? It's been rough. It's been a very heavily concentrated marketplace of those names doing all the heavy lifting. Well, now you can invest in tech in China or in maybe emerging markets in Europe. There's choices, and money's leaving to go after those choices. We're not going to get that back anytime soon. So in Q4, we had that earnings spike that kind of got us over the hump up into that 6100 plus area in the SPX. Well, that's gone. We're out of that with almost a 10% area. That puts us in correction territory. And on the NASDAQ, we already are. The tariff worries pushing 25% on autos, another 20 on China. It just keeps going, souring guidance even more. 44% of the firms that already did earnings mentioned tariffs. They were flagging that in their earnings reports on forward estimates. 366 out of 500 stocks are in correction territory from March 10th. That's a lot. So stock buybacks, we've got a chart for that. We can go in and look. Let's see here. Well, maybe yeah, there it is. Stock buybacks. We can see buybacks started to flag back in November. And sure, we had a little bit of bump from December into January, but since then, it's just heading to the downside. So companies are hoarding money. They're giving a really sour forward guidance if they give any at all. They're dialing back the amount of buybacks that they're doing. So this is less buying in the market. CTAs are buying less. I don't have a CTA chart, but CTAs are buying less. Capital expenditures are down, right? We have that. When we start getting into earnings yields, we don't have a current number for everything, but on this we can see yields are starting to rise. They're getting concerned. We've got earning growth quarter by quarter, big dump. Now this only gets us into September of 2024. We got to get through this quarter to get this to update into the new quarter. But that spike up from June to September of last year, you really think that the projections are that this will rise again, because this will be from September to December for that quarter. That's what the missing piece that we're going to get next. And it probably goes up to the line, maybe breaks it and sets a high. So we get up into this area. And then we're going to get the next quarter and it's going to look something like that. It's going to be one of those. So this is going to be off for a while. It's not going to help us, not this one. But if we look at earnings on the month to month, and this rise up that we were seeing from August of last year, or from March to September, when we get updates on this, it likely has another rise a little bit higher, and then it starts to drop. Because S&P earnings are headed down. They're going to be downgrading their forward estimate even more. All the earnings that we just went through, those companies that are reporting, they're going to show up in this, and it's going to be heading to the downside. So GDP estimates are going to fall. Inflation estimates are going to rise. Yeah, I mean, Macy's, though, I mean, Macy's has been on the rocks for a long time. You know, it's like Kmart was on the ropes forever. But you're right. It absolutely is another sign, too. Companies that just, and look, they keep talking about consumer spending, right? And there was talk 2 weeks ago about consumer spending and how it was lagging. And the numbers came out and showed it wasn't lagging. And it's like, okay, what are you guys talking out the side of your mouth about the consumer spending dropping down? When I dug into that, they said, well, we were misquoted. The spending is still there, but they're doing it on credit, and their credit is down. I was, well, that's a completely different headline. I don't know why they got misquoted that way. That is a huge, you know, that reminds me of like McDonald's has so much real estate, and if they ever wanted to, McDonald's could just make money with the real estate that they have. That big building that Macy's has in New York City, imagine what they could do with that. That's huge. Of course, they're probably, you know, up to their eyeballs in debt, and it isn't even that. Once they settle the score everywhere, it won't even be their building. But It's huge. So we've talked before about how there really isn't much new in the market, right? Things just fall out of favor and then they come back into favor. And what we've seen before, we will see again. So for the last 20 years, the government has been propping up our economy and stepping in every time we slow down and just gives it a little juice of gasoline and away we go again. But it hasn't always been like that. The idea is this administration wants to go back to a time before that. So when you dig into the history books and you go looking at when that was, it was Reaganomics. It was a two-term president who spent a lot of time transitioning out of the old framework and into the new framework, and it took 2 terms. And we fell 27% in the S&P before he got it turned around and we were on the new framework. Now, they didn't help him any more than they're helping the current administration. So he had to fight tooth and nail through the whole thing to get it done. But he had 8 years, 2 terms. This administration doesn't have that long. It's curious, and I'm concerned that there won't even be enough time, and they'll dismantle half of the current system without ever getting the new system in place. Then we get a new administration, and they just dig us out of the hole with a bunch of government spending, and all of this was just a 4-year downturn. It's possible. The thing is, we just don't know. So all of this data right here is all about the buybacks being down. Part of it is the tariff tweets. Some of it is just projections from like Goldman Sachs and stuff. I went out and gathered a bunch of data, but the end of it, if we read all of those, yeah, it's more like 30, isn't it? I know, man. My age is showing. It's all right. It was back in the way back, right? Back in the day. So higher interest rates, tariff threats, tariff costs, weaker forward guidance, all of that is shifting priorities from the companies, and they're not as interested in doing stock buybacks. It's better for those companies to do things like dividends or debt repayment programs and not focus on buybacks. And then we've got capital expenditures, the money that's being spent by companies towards things like NVIDIA chips. So their capex is soft too. Yeah, Reagan was the 80s. That's why I said my math was wrong. It's more than that. It only feels like 20 years. It doesn't feel like 30. Is it 40? Come on, guys. You're getting my gray hair a name at this point. It was the 80s. Let's just say that, right? The Berlin Wall, all the good stuff. The space shuttle, Challenger, Cinderella, Scorpions, Guns N' Roses. Y'all remember? It wasn't that long ago.
Yeah, you and I are the same age, so yeah, it was it
Yeah,
was it was a lot of years ago, man. Let's just put it that way.
yeah, a little bit ago. I slept since then. We can say that. So if we tie all of this together, the impact is projected to go even lower. AI tried to put a number on it. They're calling for something like 5,500. I don't think that's going to hold, right? Because we've got more to go from there. Um, we still need the numbers for earnings growth, but so far it's not looking good. The thing is, it'll be a little tricky because the earnings that was reported was good. It's the forward projections from this earnings cycle that isn't good. So when we do get the updated charts, a lot of these are going to point up from here because earnings was reported well. I mean, a lot of companies had good earnings. They just fell after they reported good earnings because they said, "Oh, the future? Oh, well, we have no idea. Probably going to go down from here." And then, well, there went the stock, and we went down from there. So these charts won't be helpful if they're just projecting what we got. We need forward earnings estimates, GDP estimates, and a lot of analysts don't like to use those because it's hypotheticals and you can play with the numbers. You can make it sound as rosy as you want. Of course, the tariffs are getting in the way and they don't even know how to price that in. So, the framework, some language that we've been seeing is the administration said expect a necessary period of transition. And what we're trying to figure out is this similar to what the Fed was using its language when it was talking about transitory inflation? Temporary economic disruptions leading to long-term economic resilience. That was the proposal from the new administration. Temporary economic disruptions. How temporary is temporary? Like transitory inflation, temporary inflation? It wasn't so temporary, and this might not be so temporary either. Framework A is propped up with excessive government spending, and they want to move into an economy that is propped up with marginal economic output. I don't know how you can go from excessive to marginal and still get the same output. We'll see, right? But that's their approach. It's what they're focused on. But we have these disruptions and it's not going away. And that's why I continue to advise people, don't try to run back to the highs. This isn't a buy the dip marketplace. Unless you're just playing short-term dips, right? Run it off the lows back into the next resistance level and then short it off of that to break the last low and go even lower. These trade policies are causing so much uncertainty that that's the biggest one. Out of all of this, it's the tariffs at this point because they're not set. So once he sets them in place or gets rid of them, either one, we'll have certainty. But as long as they keep just waving them around and threatening them, then we continue to have uncertainty. And this is not political. I don't have an opinion on whether or not it sticks, whether they actually apply tariffs or don't, because that would just be an argument in economics, and politics will get caught in the middle of it. So I don't have an opinion on should we do tariffs, should we not. I don't I don't care at this point. We just have to have some resolution. So put the darn things on with a set period of time and leave them alone or get rid of them. And of course, they're not going to do that anytime soon. So this uncertainty isn't going to go away anytime soon. And then we've got the job cuts that are coming. We haven't really seen the numbers coming through yet, but we're going to get a lot more unemployment hitting those employment numbers. And those are trigger levels. They fit into these non-discretionary trading firms like VC funds and CTA funds who will trade based on these numbers, and they won't look behind the number and say, why is it that we've got record levels of unemployment? It'll just react based on the number that we get. That's coming, and there's nothing we can do about it. We continue to get volatility because we continue to have uncertainty, so that's not going away. And then all of this tariff talk is bringing inflation expectations up again. Well, that's perception. It's how people are projecting and anticipating. We can't make that go away, right? You can't make someone feel happy or sad, and you can't change their expectations on inflation. They have to see it for themselves. All of that ties together into greater recession risks. And with that recession, a much smaller chance that they come in and play save-a-ho and bring us back out of it. Sure, they're going to be there to make sure we don't just absolutely crash and burn, but I wouldn't expect them to come in and stop the plane from landing. So money is going to nations around the world that do have a normalized policy. And we don't have anything priced in yet for the new GDP forecasts, for the new sales and earnings estimates for companies, and the new investor positioning. None of that is yet priced in because we don't have a framework B yet. We're also getting reduced government stimulus when it comes to things like the CHIPS Act. That was stimulus, whether you want to call it that or not. And they're talking about rolling that stimulus back. The stimulus for EVs. Now they've already rolled a lot of that back, but not all of it. There's talk about taking more of that back. And believe it or not, Musk is right on board with it because he knows his company can survive without those EV subsidies. He doesn't need it. Ford and GM and all those guys, they needed it. They were the ones that really were promoting it because they wanted to sell cars on the EV side of things. It does. Mid-April looks like a really good time frame. If the government was to come in and do it, they would have to borrow extensively. And that's exactly what this administration is trying not to do. So I don't see how they're going to come in and try to solve the problem. They can do little things, but if they're getting rid of stimulus and trying to dial back spending and reduce the size of government, I don't see how they can get it done. Right now, there was talk about that 100-year bond and really just refinancing a lot of the debt. And that's something that Trump tried to do in the first administration, too. So, I mean, imagine if he gets that done. That could really change a lot of things. But would it be enough?
Part of this talk about the 100-year bond, from what I understand, is Trump wants a lot of the other countries, China, Japan, blah, 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 to move from treasuries, which are interest bearing, to a 100-year bond that has no interest on it.
Yep.
And the reason, the justification for it, as he says, is look, we have given y'all gazillions of dollars. Y'all have not done anything for us. We want you to move your money to this 100-year bond, and we'll consider that a great step towards, leveling the playing field. Now, it's a great idea in principle because it means that we don't have to pay out any of those percentages, yields on the treasuries to these foreign countries anymore. The challenge that a lot of people see, though, is that it will wreck the bond market because they'll be essentially closing all their positions on the treasuries and moving, on the yielding bonds over to that 100. So on the one hand, it'll be great as far as getting our deficits and stuff like that down because we don't have to pay interest. On the other hand, though, it could wreck the shorter term bond markets because all those positions will get closed. So that is sort of a double-edged sword, long-term, short-term kind of situation. And that's what this whole 100-year bond business. Signet, I know you know about it. I'm just filling in for the others about this idea that's going around.
And there's also the concern of why would they want to? At this point, we're pushing nations away. At the same time, we're asking, hey, buy our debt, please. We still love you. We want your money, just GTFO. And oh, by the way, will you please buy our debt? I shared that document that we were looking at. It's raw. It's not clean, but it's got my data in it and it's got what we were talking about. If you guys want to peruse it, look through it, whatever. So it's not to say that we can't trade. It's not to say that there are no opportunities. This won't last forever. The markets will always be here and there will always be opportunity. So you can take this as an opportunity to go shopping if you want to. You know, sectors will come back. Um, Growth and value will continue to change places, but you might want to adjust your time frame for your expectations of when are you going to start to see returns on some of those trades. If you're young and you've got a lot of time available, then really shop around with an outlook of 10 to 20 years, looking at things like the Mag 7 and how well they did in 10 or 20 years. Good, solid blue chip companies that have been around for a long time and have proven that they adapt well to new technologies, new social constructs, that sort of thing, right? And it doesn't have to all be tech either. Even something simple like Walmart still looks good. Costco, you know, General Dynamics. It doesn't have to be. Even McDonald's has enough real estate, like we were talking about earlier. It's not going away. But if you're a short-term trader, you might want to adjust your direction the other way. Get a little shorter. Instead of running, 6-week trades, try 6-day trades. It makes it more violent, I know, and it's a little bit harder, but the let me try to rephrase it this way. The last time we were in a market that was a little rough, it was that bear market, the 2022 bear market. There was long opportunities in there. And you could play those long opportunities on the short term if you timed the move up really well. Otherwise, all through 2022, if you were using 2023 options, or at least the end of the year options, your trades usually worked out well for the long side or the short side because you'd get a sharp enough rally that you could get some profit in the longs and you'd get a steep enough drop that you could get profit in the shorts. But if you use really, really short time frames and you missed your timing by even a day, then the option just blew itself out and there was no value there. So you had to be either really good at your timing or you had to give it room. And I would say that's the market that we're in. Give things room. Just give them time, or straight out play stock. Leave the options alone for a while if that's what it's going to take. And I can already hear the groaning. Stocks are expensive, but there are brokers that will let you trade fractions of a share if that's the route you have to go. So you can get growth. I remember when Google was thousands of dollars a share, and I would grab even a fraction of one share with a small account, and I would get good returns on it. And that's what it's about. It's about making percent profit returns on the money that I'm using in a trade. So there's going to be a lot of weakness, and there's going to be bad numbers coming that we know will drop this market. GDP numbers are going to drop the market. Unemployment numbers, it's going to drop the market. We know this, right? Higher inflation expectations, that's going to drop the market. How far? I had somebody asking me today, how long is the bounce going to last before we roll over? Come on. I don't know. I don't have a crystal ball. Your guess is as good as my guess, right? Will we bounce for one day and then continue to fall? Will we bounce for a week? There's no way to know. But if you go back and you look at the moves that we've done before, generally we fall for a bit and then we get a good rally about halfway back. And then we fall some more and we get a good rally about halfway back. Well, we've had a really good fall. We're kind of due for a rally back. If we can make it to the halfway point, perfect. That's fantastic. if things are really strong, we'll overshoot that half. And if things get interrupted before we even get to the half, then we're going to stall out early and we're going to roll back over again. We have to continue to carry these expectations forward. And I'm hoping in this stream today that the main message is we're not in the same environment that we've been in. We can't expect them to come in and cut rates to buoy us back up and save the market, because even if they wanted to, I don't think they can. And they don't want to. And there's still stocks that are going up even right now. So it's not like you can't find things with new 52-week highs and stocks that are continuing to perform well, even in this environment that we're in today. So there's always opportunity. Let's look at some of those names. ASTS, this is another version of Starlink. Starlink is one of Musk's companies. Obviously, this one isn't one of those that's breaking out into all-time highs, but it's a solid company, and there's not a lot of companies that do what this and Starlink does. And with Musk getting all this hate, he's turned his companies political. He's getting smacked for that, right? So maybe some of the money coming into this is because of that. Maybe it's just because it's a good product. I don't know, but it's still good, and they just got more money coming in. The news on this company continues to stay really good. I'm in it. I'm planning to be in it for a couple of years. This isn't a short-term trade for me, but I still like this company. BJ's from Canada, I believe. It had earnings, really big blowout. Now it needs to hold the half. If that half fails, I think we're going to come down and close this gap. We really want to keep it above 100. So if the bounce holds, this could be a place to get in, but you might want to, run a wait and see here. But look how well that thing looks. I mean, that looks really good. And as a company, sure, this could be one of those that suffers a little bit in the short term, but I'm not seeing long-term, weakness in this one. That's a good name, good company. Walmart's on my list, but Walmart had a bad forward earnings, and so, they're losing some confidence, and then the tariff threat and all that. But I still like Walmart. Looks really good. We've got the trading firms. Maybe we're going to lose some traders like we usually do when things get bad and traders blow out their accounts and then they just back away for a while. We see more trading activity in bullish markets, but the CME group, with that headline about 24-hour trading is going to be coming in full time by the end of next year. Who do you think makes the money on that? It's just more trading, more commissions, more profit. So ICE, CME, NASDAQ company, IBKR, Schwab, we expect all those to continue to do well. CME is breaking through the top. Why? Because futures, commissions, profit, money, right? It's simple enough. We all understand that product. I like this company. I like the group. But as I've mentioned recently, we don't want to play themes and groups right now. So if you look at CME or ICE or IBKR, treat them individually. Don't play them as a collective because that's not the environment we're in. But I like this company. I like that chart. That chart looks really good. We're still expecting airlines for a beatdown, and shorts ain't hard to find right now. There's plenty of shorts, but airlines had such a run that they've got a lot of room to go. And one of the things that came out on the airlines was the lack of government flying, right? All those people that are getting laid off from the government who aren't flying from one place to the next, getting business taken care of. So we could call it unemployment is affecting the airlines. I thought it would be, from like the bird flu and stuff, maybe the pox that was going on down in Texas, but I mean, whatever reason, airlines are still a good short. The only threat to the airline trade is energy being so cheap. Usually cheap energy, airlines do better. So it's a little concern there, but still, it's a solid short. I got more. No pox in Houston. No sleep till Brooklyn. Surely I'm not old enough to be the only one to know that one. Let's see my notes. I've got some more that are good trend ones. No sleep till Brooklyn. AGI. I mean, sure, it's just coming back up, to that previous level. And I'm on a monthly chart here, so it's a big time frame. That's like 2013 levels. But after all these years, it's finally got back up there. Now that we're here, it's very likely we're going to digest some of this for a while, but we're making new highs. You know what I mean? Like that, it's a good company. It's continuing to push to the upside. It's a little choppy when you put it on the daily, maybe even on the weekly, it looks a little rough, but put it on the monthly, kind of see where we came from, where we're going. So AGI still looks really good. AEM. And if you just run a scan for 52-week highs or all-time highs, you can find these names, dig into them, see what they are. You don't want SPACs or some new IPO'd name that just showed up last week. That's not really, what you want to mess with. But this mine, and both of those were mines and minerals and precious metals. This thing has a chart going back to 2005. It's 20 years. You got Waste Management and a paper company. We have, I think there's some energy names on my list somewhere. I can dig through them. Some energy names that are doing really good, breaking out into new highs. This one's precious metals too. Wheaton. So it doesn't have to just be, the hyperscalers. It can be some of these other ones. These are value plays rather than, well, I don't know if we want to put precious metals and mines in value, but they're not, growth tech names. Thank you. We're still inside day. The CPI today did not resolve the market's expectations. Most analysts thought we were going to get the numbers that we got, so it wasn't much of a surprise. And it looks like we're still waiting on something. Well, when we, look around and kind of ask, what the heck are we waiting on? We've got the government shutdown on Friday. We got FOMC next week with OPEX next week. And then we have the tariff deadline on April 2nd. Oh, and we have that really big event from NVIDIA coming up. It's huge. It's like most of the NASDAQ 100 is going to be there. But for today, we can't even get up to yesterday's high other than, during CPI when we popped up there. So we're inside day at this point. The advancing minus declining issues are coming back. We're almost to zero. So if we get above zero here, we got to get above 250 next, but that's a good starting point. Cumulative tick is being led by the green line. It's above the zero. They're not quite spread out in a fork pattern, but I like how this looks. This says bullish in a broader backdrop, and the ticks are mostly in the green, at least since 2 o'clock from that last drawdown. Right? The concern is that we're going to have another drawdown because the ticks are a little weird. We can't continue to get higher highs, right? It tops out. So what happens is we get higher lows until there's no more room for those, right? We get equal highs, higher lows, and then it runs out of room and it dumps back down like it did earlier today here. We were getting those higher highs and higher lows, and then we got equal highs. We couldn't go any higher, and we ended up not being able to get higher lows, so we rolled over and took a dip. It's coming again, you know what I mean? Like, that's the norm. But on the pullback, the question will be, are we going to pull back like we did in here, where we just get back to the zero, or are we going to pull all the way back and get down into the negative again? Because we see what happened earlier when we did that. We broke through the half. That was a little bit of news too tied in there. You know, that wasn't just price action alone. So, you know, maybe if the headlines stay calm, price can stay calm. But this is telling us that we've still got something on the agenda for the week that the market is worried about. Just saying. What else you guys want to look at? I do have some tools. If y'all you wanna look at my tools. We got the United States interest rates. Not much of a surprise. By the way, this is TradingView, and most of these are not a formula. They're just something that you can search for. So if you was to type in United States interest rates, for an example, it'll offer you a number of different charts. You got CPI, whether you're doing it with or without inflation put into it. You can get some pretty good numbers month over month, year over year. And it just helps give you a little bit of insight, you know, where we're at. But it doesn't have the expectations. Those, you generally have to buy expectations from some macro fund or firm out there that does all the legwork. PPI, it's not really going to be too insightful with those numbers. Consumer confidence down 9%, 7.5%, 11%. You know, this is a part of the reason we're selling off, right? Unemployment numbers. This is going to get real ugly real fast once those unemployment numbers start picking up from the government. Non-farm payroll, jobs created, job offers, jobless claims. I've got a really good chart when it comes to jobless claims. I didn't build this one, but it's shared on TradingView, so you'll be able to get it from me just like I got it from somebody else. Hopefully they have an updated version. Maybe I passed it. That's bright. So we have the civilian unemployment rate on the top from the Bureau of Labor Statistics. And then down at the bottom, they've got gold and silver miners kind of tied to it with important bottoms and these drawings, and they've got a lot of doodles all over the place. But it goes back for years. They did a lot of work here. 1948, they went back and measured out all of this and tied in these levels. As I mentioned, this isn't mine. I found it. If you was to search on YouTube, not YouTube, just hit Google and search unemployment rate TradingView, you'll find people and their charts. Of course, I can just give you this one, but if he changed the drawings, then I don't have them, right? Because I'm not linked to his shared chart. So it's up to you. I will share it if you want it. Otherwise, you'll want to search for his new one on Google. This is a big picture point of view. It's a monthly chart. So, things don't happen in a moment's notice unless it's something like COVID. We could see that COVID spike way back here. But generally, these things take time, right? Months and months of time. Right now, I do have some formulas, things like Fed liquidity and that sort of stuff. It could come into play when we get closer to QRA, but where we're at currently, I don't see how it'll provide much insight. But there are formulas that you can use. I mean, look how wild this one is. I picked that one up on Twitter from some finance guy. The cool thing is, if you get a crazy formula like that, you can stick it into AI and ask it, hey, what is this formula? What's it represent? How can I use this chart? And it'll give you a really detailed explanation of what that chart is and what you can use it for. So that's pretty handy. The one we were just looking at was banking reserves, or basically liquidity in the market. And we can see that liquidity is coming out. But we can track margin debt when it comes to like the big trading firms and their current level of margin, and whether they're at risk of margin calls, or they overextended or not. And we can see that it really sold off after 2022, and we started to come back out of it. And they've been increasing their margin reserves, so they're nowhere as extended as they were going into like 2022. It's a good question about priced in. It used to frustrate me to no end when people would say, "Oh, yeah, it was priced in already." What the heck does that mean? And how did you know? How can you see it? Show me. So the one that I first came across was pricing in when it came to Fed's rate decisions. That's a really good place to start the conversation for others who've ever heard that phrase. But of course, it's not just that, right? We can price in CPI, PPI, earnings expectations, GDP forecasts. We can price in a lot of those things. And so you would have to look at a different tool. But since this tool exists for FedWatch, and I know we can all get it, I just figured we'd start here. When we're thinking about an FOMC meeting like we have coming in next week, and we talk about how, oh, it didn't matter what they were going to do because it was already priced in. So far, they're pricing in that there's no rate cut, and obviously they're not hiking. So this is priced into the market at 100% at this point. If they begin to unwind that, we would see that activity not only here in the chart, but we would see it in SPY, the Qs. If they unwind that because of a cut, we would likely see SPY rally, the Qs rally, right? A lot of growth names go up, value names go down. So we would see them unwinding what has been priced into the market. So that's a pretty easy way to start the conversation. How do we see if it's GDP, CPI, inflation expectations? For those, you usually have to get a quant service who's doing those projections and then forecasting that out into the chart to show whether or not it was priced in and where. Mentor Q is one that comes to mind. They use the COT report to do that. It's not cheap to get Mentor Q as a service, but they do the legwork and they talk about what metric on the COT that they were looking at to show you what has been priced in. For those of you who don't know, the COT report is the Commitment of Traders report. And when it comes to the COT report, there's a lot of these out there. There's global COT reports. There's COT reports for just agricultural stuff, all over. So COT is a big deal. And you can go to different places to see this. I like Morningstar. The problem is it's just me looking at it, right? Or if you go there, then it's just you looking at it. You alone or me alone, we may not be able to see from what we're looking at here how that affected the S&P or the NASDAQ, how that was priced in which case you would need one of those funds or firms again, right, to do the legwork with the data to tell you how they saw it, where they saw it, and what it means based on the numbers that they have. So Mentor Q, that's one place that I know gets the COT reports and applies that to the S&P and the NASDAQ in their write-ups. They'll do like these blog posts and they will explain what they see and how they think it's being priced in or unwound out of the market. They're not the only one. I'm sure there's others, but it's the one that comes to mind right off the top of my head. Was that today? Oh, shoot. Hold on. Got a headline, heads up headline that the current administration may be speaking in a few moments. It would be nice to see retail have enough back to do the work, but the only time we've ever seen retail unite strongly was during the whole GameStop Reddit theme, and most of that liquidity was ignorant liquidity. And I don't like to say that, but it was true. There was just so many people following one Joe Schmo on YouTube, and well, as long as the Roaring Kitty doesn't drop his shares, I'm keeping mine. Then everybody just piled in and piled in and piled in. Don't get me wrong, there were smart people playing in there too. There was a lot of really sophisticated, smart players in there. But the masses are not sophisticated. And that's just the fact of life. So this is a COT report, and we can see asset managers and institutional funds as a group. We can see their current position long, and we can see their current position short. And if we put those two numbers together, we can see their combined total position. We can also back check that and see, well, what was it last week? And is this number increasing or is it decreasing? So that's helpful, right? To tie those pieces together. We can also look at leveraged funds and other reportables, but Mentor Q does these COT reports really well. And if you go to their Twitter, for an example, and look, I had an agreement with these guys. I was using their platform for free for a while. They're really nice. It's just they're pricey, and I have Spot Gamma. And when push came to shove, I had to make a choice between those two, and I chose Spot Gamma. So I don't have anything against them. I just don't have their platform. They come out with these COT reports on their Twitter for free sometimes. Here's the CTA positioning. I mean, that's really handy to get CTA positioning, right? That's excellent. Take that whenever you can get it. But they'll do the COT report and talk about what is being priced into something like gold or the NASDAQ, oil. So when they do post something like that, man, grab it. Grab it with both hands. And it's good to have something like this, whether you're using Spot Gamma or Mentor Q or one of the others that are out there. It's good to have something like this. That's funny. Man, I'm surprised. Oh, I've only gone back 19 hours. I guess they are posting way more than I thought. I thought I had scrolled back for days. All of this is still from today. It was just 19 hours ago, but go back to yesterday. I think they come out once a day with those CTA reports. And I've shared them in chat when I did have this as a service. I shared in the chat. So that's a good way to see it if you're looking for it. The other one is they're only doing CTAs. It won't necessarily, or COTs as well. It won't cover everything like GDP estimates or share buybacks. It's not going to cover that stuff. So you have to find a company out there that's correlating that data because there's not a chart for it. At least I don't have charts for estimates. I haven't found one for free. I know when I Google it, and you can go to AI and ask for it, AI will give you sites that you can go to, but you have to pay for it. So it's unfortunate, but that's where we're at when it comes to that sort of forecasting. I tell you a site that I really like. Go back here to the internet. It's called Macro Micro, and I've got it on automatic billing. It always comes out to like this weird Japanese symbols that I can't read. First time I ever seen the monthly payment for it, I was like, what the heck? What did I just buy? What is that? This isn't the one. This is a company with a name really close, but not the same. I gotta find it on the other browser that I normally use. There it is. Macro Micro. Let me get logged in here. These guys are really good too. You can see their costs are not crazy extreme. This will give you a macro backdrop. You can build your own charts with their tools, and it's fantastic. I love it. It's a little heavy, right? Because you got to already know a little bit about macro economics, but they do have educational material too. So you can dig into that. They've got YouTube channels, they got a community with user insights, an academy. So if you're looking to learn macro concepts, that's a really good place to go. And it's not crazy expensive, $20 a month if you get it, pick it up pretty cheap. I don't have the business edition, obviously. It says upgrade. I have Prime, and it always tells me to upgrade, even though I have Prime. It's just some little weird feature they have, but I'm already a Prime member. They had Yardini on here a little while back. That he did a video with him giving his outlook. There's your global recession probability at a glance. They've got the clock, which is nice because you can run that and see the wheels turn. Manufacturing cycle. It's really good stuff. So this is called macromicro.me. I find it to be really useful. especially when I can go in and I can build my own charts. Let's see if this takes me to this one spot that I really like. Now I just got to find it. They've got this backdrop where they put everything into four different boxes, and those different boxes will tell you if we are doing good and getting better. There's the COT flows for global. If we're doing bad but getting better, doing good and staying good and getting better, right? They have these four different categories. It's absolutely fantastic, but it doesn't change much. So you go in and you look at it and you're like, yeah, okay, it's the same thing that it was last week, right? And then that's it. You move on because nothing changed. And these guys do a really good job of writing up blog posts that will give estimates and forward guidance too. But you have to wait for them to come out with the data. I know what I'm looking for. I'm just not finding it. I will very likely find it later when I'm no longer streaming and then say, there it was. I knew it was around there somewhere. Sure enough, as soon as I move the screen over, it's under Traders Insights. So it's under Charts, Traders Insights. I just didn't scroll down. I was stuck on that page right there. These four groups right here. So you got your high index value and in a downtrend, or high index value while being in an uptrend, and then low index in a downtrend or low index in an uptrend. And it explains on the side what that means, right? So if it's high and upward, the best scenario, as all the fundamentals are great and it looks like we're strengthening even further. So this one right here, that's the best one, upper right corner. The worst one would be low index value, low downtrend, and that would be this one. The worst case scenario, as the fundamentals are poor and everything is still declining. Like, oh, that's bad, right? So that's the worst one. Oil and copper, they're in the toilet. High value, but in a downtrend, fundamental wise, Japan, Singapore, the US dollar, Europe, wheat, right? So things that are high value, high uptrend, basically everything. US stocks, Taiwan, Australia, emerging markets, which is China, Brazil, bonds, corporate bonds, high yield bonds, corn. That's a fair question about the Schwab holding stock and selling it to you. Are you getting the best price? Um, There's been a lot of argument about that over the years. So there's two pricing models, places like Robinhood. Yeah, mainland Asia. Yeah. Um, it's funny because in Europe, with all the immigration and everything that was going on in Europe, when they would have crimes happen by somebody other than someone in Europe, they weren't able to point to that person and say, um, "Oh, this person's from China, this person's from Africa, this person's from, you know, Brazil." They would have to point to them and say, "Oh, that's from the Asian continent," right? Keeping it really vague without being country specific. And that's what it reminded me of when you said that. It's not China anymore, it's mainland Asia. When it comes to um, the two different versions, a Robinhood style broker versus a broker like Schwab, IBKR, those guys that charge you money to fill your order, they're under obligations, right? So if you're paying for the trade, if it's not commission free trading, then their obligation is to get you the best bid and ask for your trade. And they'll hit you up across all of the marketplaces that offer it, even if they offer it, because they're obligated to give you that best price. But but if it's a broker that's offering you commission free trading, then no, they don't have to offer you the best price. If you want to dig deeper, it's NBBO, National Best Bid Offer. I threw your question into Chat GPT, kinda, right? Like my own version of it. And it says, most of the big brokers nowadays don't fit that description of having a ton of stock on hand. Now, they have clients that have it and they will use their clients' shares, right? And they're allowed to because the client gives them permission. So, if we take it from the same concept, right? Because you're not really arguing about where the shares come from. They had them in house, whether they belong to Schwab or one of their clients. Are you getting a best price? That's really what you're asking. And the answer comes back to what's your contract? Because if your contract is for free trading, no, you're not getting best price. But most people won't haggle about it because you'll be getting a fair price, even if it's not the best price most of the time. Where that gets tricky is if it's hard to borrow. And does your broker show that? Thinkorswim does, right? It has up at the top. If we go to, let's go to something like Riot. Riot, EXTO eligible. That's the cues. It didn't change. There you go. So Riot's got more than enough. You could trade it after hours. It's got a lot of opportunity. Um, Trying to find something really small that I think would not have a lot. I just try AMD. You know, if you find something that's hard to borrow, it will say it up here. Hard HTB, hard to borrow. And when that happens, you might, especially if you're trying to trade it in pre-market, you could find some really mispriced stuff. So really consider what broker you're using when it comes to what you're trading. Tasty Trades, for an example, does not offer a lot of penny stock stuff. And so when I want to trade that way, I already know, don't even turn on my Tradovate, my Tasty Trades, because it doesn't have it. Here's some of the answer that it gave too, by the way. In essence, any brokers don't hold stocks. They connect you to the market. They don't fully bypass it, they route through it, sometimes via market orders. Because of the NBBO, they might take a little bit off the top, but they're not going to completely gouge you. So there are rules in place that try to protect you as much as possible. Yep, hard to borrow, HTB. That'll be a good warning for you going forward. If you look at that one and you see that hard to borrow, especially if you're trying to trade it in the pre-market, just let that be a warning that you very likely are going to have a hard time with it. Oh yeah, look at that. Nobody was able to trade it. That's wild. Hmm. Yeah. I mean, it had a lot of news, especially when with this agreement, but then it just locked into place, and I don't see anything that talks about the lock. It's an ADR though, so maybe the ADR got locked by the brokers. Let's see if AI can help us with this one. It didn't find anything, and it checked some really good sources. So it's not under a lock limit or anything like that, which it shouldn't have been anyways. I mean, it didn't. If it didn't trigger it on the way up, it wouldn't have triggered it on the way down. I just couldn't think of anything else except maybe they yanked the ADR license or something and it locked in place. But I'm not seeing anything, and it didn't see anything either. Maybe it really did just dry up but that is very unusual price behavior. And when I see behavior like that, it's almost always some sort of M&A deal or some kind of lock or a freeze, and is very unusual. It's weird that we don't see the HTB out here too. We see it here. We don't see it here. Maybe it's just because I'm running two charts here and nope, plenty of room. Oh, it's weird. So yeah, when you're checking on these in the morning, just jump over to the trade tab and check to see if it's showing hard to borrow. That way you don't do the legwork of charting it, getting ready, finding a trade that you like. You go to get in and you can't get filled. That would be really frustrating. Do all that effort and work and then find out you can't even get the trade on. What's weird is this isn't the only one either. There's a couple of firms in China that are real estate firms getting into EVs and data centers. This one seems to be getting into some sort of EV. Come back over to this. Hmm, that's a weird one. I know when I see this, I don't like it. I would not mess with it when it looks like that. And if I'm in it, I would get the heck out. That's a good point when it comes to data centers. Um, oh, was it Google that just came out with their new AI? I didn't get to watch the video yet, but 4 hours ago. So this is a website called Wired, and it was this headline: Google's Gemini robotics AI model reaches out into the physical world. They got a AI and they put it in a bot. And there's a video on YouTube with that bot. And they're linking with Gemini to do it.
So, what happens when you have an AI robot in a family where dad's a serial killer, and the bot is learning?
I guess he'd be really good at it.
Your technique is very inefficient.
It's it's funny. We were watching iRobot the other day, with Will Smith in it, and I was telling my wife about these AI companies that are building the robot to go with it, and how a lot of these stocks are coming out with announcements that they're now building robots to go with their EV vehicles. Like I think it was Li Auto that is now building bots. They want to be like Tesla, and Tesla's building bots, of course. And it's there's supposed to be bots that'll help drive the vehicle and bots that will help build new vehicles. So bots building bots at that point, but it's becoming more and more popular. I guess it wasn't Lee. It must have been, maybe it was Neo or XPEV. One of those EVs are building bots now.
I mean, a bot driving a vehicle is no different than, I mean, it's AI still driving the vehicle, whether you got a bot in the chair or not. It's just
Exactly.
kind of
Yeah.
Johnny Robo Taxi there from Fifth Element. Um, Johnny Cab, that's what it was called. But I mean, whatever. Some people probably just feel more comfortable having something in the seat. You just put a blow up doll there and get on with it.
No.
Hey, they do it for what's the carpool lanes?
I seen those headlines. Yeah. So yeah, it's becoming more and more common for these companies, and even there's always been rumors about AI and robots with Apple, no less. So Google, Apple, uh, car companies getting into robotics. They keep saying by 2030, robots will be so common and cheap that they'll be mowing your lawn, washing your dishes, folding the clothes, taking the kids to school. I just want one that'll make coffee. You know what I mean? I'm not asking for too much. Just just make the coffee.
Good morning, Master. I have prepared your special blend.
This HSAI was on my radar this morning because of this Mercedes-Benz deal, LiDAR sensors. I was going through a lot of LiDAR sensor companies when I was dealing with drone technology and vertical takeoff and landing vehicles. I was surprised to see Mercedes-Benz name connected to LiDAR sensors, but whatever. It's not only for those, right? It's just this company now has secured a deal with Mercedes-Benz, and so it was getting a nice little pop this morning. HSAI. It was $13, you know, after earnings Monday night. It hit 24 plus in pre-market. Boston Robotics. I didn't know they were still around. The indicator estimates the likelihood of deterioration in global economic conditions in a given month, with 50% as the baseline. A reading above 50% for an extended period indicates a high probability of a global recession.
Well, when did we have our last one?
A global recession, it mentions 2000 during COVID. We had the brief pop. Otherwise, way back here with the global recession starting in 2008 through 2009, the financial crisis.
Well, I mean, just kind of looking at your graph there, we're overdue for one. I mean, I'm looking at the gray peaks. Um, so, I mean, you got three peaks there. It kind of, with the blue lines, it kind of looks like we're due for one. I mean, nobody wants that, but let's just be honest, these things happen.
And they got bigger every time. 1990, 2000, 2008, each time we went higher on here. This little one, that little COVID drip, it was so fast it was done. It didn't have time to really build. But this isn't current. I know that. I can go back and check to see how old the data is, but it's below zero and it's pointing lower, but it is coming into a support level with a previous low. We could bounce there and go higher. I love that website though. There's days where I just crawl through this place reading the latest stats and figures. The next update on this chart will be April 14th. And we get upset if it gets above 50 for an extended period of time. Last number was at 29.96. The number before that was at 30. So it only dropped a minuscule amount between those two numbers. It wasn't like a massive reversion from one data point to the next. If we zoom in it a little bit, that's 6 months right there. So we had a number in January, looks like February 1st, and then we got one March 1st. So we'll be getting another one first week of April, it looks like. Second week of April. Global recession probabilities. I guess that's just the same chart, but all by itself. It doesn't have the ASWI behind it, ACWI. And it is global. If we want to look at the US, we have this chart. Make sure that we use the same number. Updates on the second Monday of every month. It's currently sitting at 11.84, and it was at 8.49. I guess it's just like it sounds, the probability of a recession in percent basis. So we have a low probability of a recession at this point because we're running at an 11%. But it is increasing because the last data point we were at 8.5 and now we're at 11. So it's increasing.
Okay, so let's extrapolate how long we moved. What was the acceleration kind of idea here? From, in other words, from when we went from stable into recession took X amount of time, then can we extrapolate if history repeats itself? Based on where we are now, what might the chart predict?
Oh, if you want a time frame, I just posted in my Discord today. I'll bring this post over and put it into the chat. Here's a cycle of economic drawdowns. So I'll bring it up in the screen where we can see it. About every year, the S&P will drop 1%. That's not a surprise. About every year, we'll see the S&P drop 5%. Again, not a surprise. About every year and a half, we'll see at least a 10% drawdown. Every 2.5 years, we'll see at least a 15% drawdown. Every 4 years on average, we'll get at least a 20% drawdown. And every 10 years or so, we'll get about a 30% drawdown. How's that for some statistics for you?
Okay, so where does that put us now? We had the August pullback. I mean, like, When's the last time we had the 10, 15, 20% pullbacks?
Let's find that out. I'm going to feed that data to AI. And ask for the 15, the 20, and the 30, because the other ones, I mean, they're not. We know when we had a 10% drawdown.
So you liking Grok over Copilot lately?
It really depends on what I'm asking. If I want it to go fetch information, I kind of like Grok. If I'm just wanting some background and some depth, say law or something, I would rather use Copilot.
Yeah, Copilot's kind of bland, and Grok is a little bit more flamboyant in its responses, which is fine either way, don't matter. But yeah, if you just want statistics and stuff, I think you're probably right about Copilot.
One thing I like about Grok is it has this deep search down here. And if I click that, it will show me how it got to the answer. And it'll, even if I give it something really crazy like the probability of a soft CPI, if I ask it that, it'll first say, what the hell is soft CPI mean? And it'll answer that question on its own. And then it'll go and try to figure out the probabilities of us having a soft CPI. And it'll show me everything that it looked at to get that answer. And it's really cool how it does that. So this says we had a 15% correction in 2022, a 20% correction in 2022, and a 30% correction in 2020. So that was a really cheap answer because it's using 2020 and 2022.
All right, now project it forward.
Let's look beyond the 2020 COVID and ask it to do a search if we didn't use that one.
Missouri, you trying to get a crystal ball answer?
Nah, this is a history. I wanted to look back. Oh, you mean Mazzidi looking forward? I think he is. I just want to look back and see when the last one was.
Well, I mean, things kind of do go in cycles, but I'm not. I mean, obviously, we don't have AI is not going to predict anything 100%. If it did, J.P. Morgan would be doing it too. Um, but it is always kind of interesting. AI says the world is coming to an end, but um,
It says the last time we had a 30% drop was the 0708 housing crisis, and before that, the dot-com bubble. But there was like flash crashes that added those too. There was the dot-com bust, the Black Friday. We had those little micro flash crashes, and then you have to kind of
well, and
consider do those fit?
cumulatively, yeah. I mean, when you have those little micro crash flashes, they push off
Yeah.
the bigger events. The bigger events happen when there's just continuous smooth sailing and everybody gets complacent. When you have these little small tremors or flash crashes, whatever you want to call them, that keeps people more heightened as far as their senses and stuff like that, and their trading. And I think that pushes off stuff. And we've got different regulations on the markets now too. So, lock limits and all that kind of stuff.
I think the trading has changed so much that the cycles are just accelerating. I don't think that the old numbers offer us any sort of help. There is waveform statistics, right? And there's a stochastics model, not the indicator necessarily, but waveform stochastics that talks about, you know, uh, necessary moves to the downside in the markets because it has to. I don't subscribe to that theory necessarily, but a lot of very smart, nerdy people have that as a part of their logic. And it's hard to disagree with some of the brilliant minds that are out there. But if you listen to them, we have to move in a wave, and that there is going to be drawdowns. And I mean, we do move that way. Markets, they don't just go straight up. So the waves over time have to get bigger and smaller to match the cycle.
I saw something the other day about the Warren Buffett PE or something like that ratio, and it said we're 200% above, right at 200%. I can't exactly remember what it was. It was in that video that Jeremy had posted about how ETFs manipulate the market and everything. But anyway, it basically said we're in an extreme overbought situation. The thing that gets me is that every time these kind of things happen, it's unbelievable the number of doomsayers that come pouring out of the woodwork. It's like they just sit back and wait for any opportunity to come jumping up and down, and the sky is falling, the sky is falling.
Because they know it gets eyeballs. All they're doing is selling a subscription to something, right? They want you to see their video so that they get more ad revenues. I mean,
yeah.
I get it.
I mean, that's capitalism. Okay. But I mean, it's just, I think it's bad capitalism, unfortunately. It is capitalism, but I just don't. Anyway, whatever. But I mean, there comes a time though when the markets are going to try and shake people out. The real question, I guess, is, I mean, you got all these institutions that are competing with one another. So if the market is shaking people out, who's getting shaken out? I mean, the retail traders, I don't know the ratio of money from the retail sector versus institutions. It can't be, or could it be? I mean, could it be on par? Could the entire retail sector be on par as far as the amount of money that the institutions have as well? I mean, I don't know these things, but they talk about the markets pulling back and shaking people out. I'm like, well, who's getting shaken out? That's something that's always kind of puzzled me.
Well, if you think about, there's so many different groups, right? So CTAs, they're going to buy with non-discretionary buying, right? So they don't get a say in the matter. VC funds, they're going to buy, they don't have a say in the matter. So when those funds, quote, getting shook out? I mean, if the metrics that define their trade logic say sell, they sell. And it doesn't matter if it's a good time to sell or a good time to buy. They just do what the model says. So that's just one group. We call them non-discretionary traders, and there's a lot of non-discretionary traders out there, these funds and firms who don't make decisions. They just follow the model. Then there's people who follow the money. Those funds and firms will look at where money flows are going, and they'll chase after that money flow. So they left the US. Did they get shook out, or did they voluntarily leave? The only ones that I ever feel, quote, get shook out are retail traders, the uninitiated, uninformed retail trader who says, well, I bought Google, I bought NVIDIA because it was the best darn thing out there. AI is going to rule the world, and now it's down, and I'm losing money, and I can't take the pain, and I'm going to leave my trade, and I'm getting out. And they got shook out. So, I guess we have to define shook out first.
Well, I guess when you're seeing these rollovers to the south, we have to say, okay, why? Obviously, a lot of this, excuse me, a lot of this, I'm sure, is political talk or political uncertainties. And people are just getting out because they don't know what's going on. But when we have like the August pullback, I think it was August, we look at that and we say, okay, what happened? Were people just taking their profits? Were they, uh, we kind of wonder what causes these events. I mean, obviously now we can blame it on the tariff talk, but maybe that was just, the trigger. Maybe people were waiting to do this. And we say, well, okay, but what was the underlying reason? Were they just trying to take profits? Were they trying to, um, whatever? I don't know.
You hit on something that I notice I do a lot, and I don't know if this is common or if it's just me, but I run a narrative on things that I trade. So it's easy on the S&P because I'm there every day. It's not so easy on, say, AMC because I may only trade that like once a year. But this narrative is a continuing running narrative. It is like a story that continues to unfold every day, right? So when I look at the S&P and I look back and I look at August, for an example, and that downturn, well, when I look at that, I'm like, oh yeah, that was August. They were Japan carry trade unwind and the VIX short spike that took us to 65. That's an event. I remember that. It was a benchmark. And then I scroll back and I look at the next one, and like every one of these major turning points, I know the headline that went with it. And if I don't know, it's because it wasn't a big enough downturn that I didn't even bother. Like, well, whatever, we had a down day. Yeah. So that narrative really helps when I try to evaluate what are we doing or what do I think we're going to do next. It's, well, have I seen this before? Oh yeah. This really looks like the start of 2022 when we were at the top of our game and inflation was running out of control and the market told the Fed they had to cut and the Fed said, "No, we don't. We don't have to cut. We're great. Inflation's transitory." The market knew it wasn't. It started to sell off before the Fed took control. It's kind of what it reminds me of right now, that we're in this so much confusion, like we were back in 2020 too, when there was just so much confusion. Nobody was on the same page and everybody was disagreeing about where we were going to go next. It's kind of like where we're at right now. So we can always just look at the candles and we can say that's a double top, a head and shoulders, a wedge. I like to look back and apply what the heck was going on during that time. What happened here? Oh, that's the bear market, high interest rates. That's the carry trade unwind. This spike was Japan when they protected things and they came in and defended the yen. Every one of these major points, I try to understand what the hell was going on during that time. Maybe I have the answer. Sometimes I don't, right? And if I don't, I really try to find it because it helps me understand what's going on in the market.
So it seems to me maybe what we should do then is assign a weight to an event. Japan carry trade is just making up numbers to illustrate an example. Well, that's a 3 out of 5, and so that we expect an X percentage pullback, this or this happened, and that's a 4. We had a bigger pullback, and then see if we can't figure out where these tariff talks would fit on that numeric scale.
I mean, it's not a bad approach. The idea, though, in most of my trading, I never try to figure out what's next, right? Like the whole crystal ball thing, because there's just too many variables. And so I try to lay out a list of, well, what would we need if we were going to turn all of this around and go back the other way? What would we need to turn it all around? We would need certainty in some things. We'd need a rising GDP. We'd need, stock buybacks to pick back up, better earnings. Like we could just list out all the things that we have to solve this problem.
Yeah, definitely. I could see your point in that there. And it's sort of like, instead of complaining, let's put something on the table. And, because we see a lot of people, they complain all the time, but they never put anything on the table. So we say, okay, fine. What do we need on the table here to make this work? And um, GDP, does GDP make? I don't see GDP being. Maybe I'm wrong, but I don't see that being a day-to-day metric
Right.
kind of thing. I see it being more of a week or a month-to-month kind of metric.
The
Uh,
forecast comes out every month, like estimates, GDP estimates. We get those all the time, estimates, but we get quarterly updates. And there's an app that you can get for free on your phone that I use to keep track of GDP estimates. It is called, let me pull it up, Economy Now. I'll take a picture of it so you guys know what the icon looks like. It's free. It doesn't cost you anything to have it on your phone. And in fact, I'll just send you the other one, which is called T Economics. So the picture has both. You can skip the picture that has ETSY in the middle. It was in the middle. So there's 3 apps that are going to show up in this picture, but you only want the top one and the bottom one. Believe it or not, there's some really great apps for tablets and phones that have to deal with macroeconomics, even options material. You can find really good stuff, not necessarily free, but I just shared the picture. It's called Economy Now, and the other one is T Economics. Both of those are great. What I pulled up here, I went to Google and I just typed in something really simple like stock market events in history. And it gives us this really big picture from 2009 all the way up to like 2020. Obviously, it's old, it's just some picture off the internet. But I see the market this way. I look back in things since I've been trading, right? I don't really care about, like, oh, 2008 housing crisis. Only unless there's something in that time frame that I need to study. I don't let that distract me. I focus on my time frame and what's been happening since I've been looking at the S&P, since I've been trading it. And I don't write the words necessarily, but to me, when I look back at a certain time frame, I remember, oh yeah, 2018, the Fed saved everybody at Christmas. They called a special meeting and brought us out of those lows. Every one of those events, since I've been trading, I remember the event. And if I don't remember, or if I didn't know, I went back and studied it to try to figure out like what the heck happened during this time frame. So if you can put together a chart like this on things, it can be Google, Apple, the S&P, it doesn't matter what it is, that helps you understand the price action of what the heck happened here? Why did we go up? Why did we go down? Why did we stay down for so long? It'll help you better understand what's coming and then what we can do about it. Yeah, there's a good one. This one is stock market volatility that goes back to like 1928, World War I, World War II, Korean War, Cuban Missile Crisis, Gulf War, Oklahoma City bombing, 9/11, the Iraq War. That's some crazy stuff. Oh, hey guys, I got to put you on hold for a second. All right, sorry about that, guys. So yeah, it helps when you for me anyways, it helps when I put the market moves in perspective to have a better understanding of, what's happened. You technically can do this on an intraday basis too. The moves obviously would be smaller, but you can tie them to like CPI this morning. And, especially say Trump news during the day, if you're able to look at it and point to a particular spot and say, oh, yeah, the EU closed at 11:30. That's when this drop started. We had the 10:30 auctions or the 10-year auctions at 1 o'clock. That's when this move happened. And then you get a better feel for the day to day. And when there's always this argument about random walk price action versus specific price moves and whether or not we're in a random walk environment or not. Sometimes we are. Sometimes we're in a market that's deliberately moving because something is pushing on it. So it helps trying to put the pieces together to figure out what we should expect. Are we in that random walk right now, or are we, in a part of a specific move? So some things that you can look at going forward would be, are we going to come out of this mess soon, or are we going to be here for a while? There's indicators that we can use, the macro ones that are confusing, or there's indicators that we can use that rely on those macro signals, like the 10-year, the dollar, what bonds are doing, yields. We can use those metrics because they'll be adjusted by traders when we talk about, oh, it was priced in. If we see the 10-year getting bid, we're likely going to see equities get bid with it. That'll be pricing in something that has changed. Maybe it'll be tariff reductions or the threat of tariffs are being reduced. Maybe it'll be an end to the Ukraine war. It's really hard to say, right? But if we start to see the 10-year rising from here and we see equities following the 10-year higher, that's going to be one of those tells that we're looking for. Another one would be perhaps the VIX continuing to fall lower, right? If we hold these elevated levels, then it's going to imply that we still have a lot of uncertainty ahead. So if we can get the VIX down as the S&P rises, that'll help. Otherwise, if we go up and the VIX stays up, there's a phrase for that. It's called spot up, vol up. And it's a unique situation, but it does happen. And that will not be good for what we want, right? We don't want to see that. It will show that we still have uncertainty and that we're only bouncing because of, market waves and stochastics, which is not what we want. So there's tools, there's workarounds. You can take the macro route, or you can take the price route based on dollar and yields and treasuries and that sort of stuff. A dividend increase, huh?
Or we can just wait until it settles down. But of course, that we never know how long that's going to be.
Absolutely. Just to be transparent, I am buying on the way down, but I don't have a short-term horizon for those buys, so I don't care. That's just me. I've never tried to call the bottoms, but if we drop, 7 to 10%, I start buying, and it's served me well over the years.
Yeah, I get that. I get that. How deep, though, are you willing to? I mean, what are your is it technical analysis that you're using to figure out if you're wrong, or are you just simply say, I'm 10% in the hole, cut it kind of thing? What do you like to do?
I won't cut it. That's the thing. Say like XLF for an example, just one of those XLs. Once I start buying, I won't cut the trade in a loss because of how far we've fallen. At some point, if we don't begin to rise good enough, I might end up cutting the trade just because it never materialized into a profit. I won't, tie up 20 years of money when I could have been using it somewhere else. But it'll be based on this just really isn't performing. Why? And at that point, I would dig around and find out if, for an example, XLF, if we fell down to $30, which is way down here at the bottom of the chart, and we stayed down there for 2 years, and it's keeping my money tied up way down there, I wouldn't kill it because it fell to 30 or 25 or even 18. I would end up killing it because it never started to move back in the other direction within a timely manner. And for timely, I don't know what that time frame would be, but that would be the reason I end up cutting it, is because it stalled and it's just not coming back again. I don't want to get stuck there forever. My patience will run thin. I just don't know how thick my patience is. I've never had to cut one in a loss, though, when I've done that. Knock on wood. It's going to happen someday, I'm sure. But
Well, I mean, for the most part, if you've got a decent stock in the first place, and I cannot overemphasize that last statement, that statement I made, a decent stock, then averaging down is always, well, can be a good, very, very, very good strategy, no question. Because assuming that it does turn back up and go north, you've really put yourself in a nice, sweet spot as far as your profit, because you've averaged down your entry level, assuming that you get above your entry. And I've done that quite a few times myself. I don't hold as long as you guys, as you do necessarily, but then again, I've also stated numerous times, I'm still a rookie, if you will, at long-term holdings, because historically I let somebody else do that. But yeah, I turned quite a few trades around by averaging down with them, as long as it's a good stock. And now I say I'm harping on that because years ago, I've had trades that I didn't know what I was doing. It just looked good on the chart at the time, and I took it and didn't understand anything about what I was doing, blah, blah, blah. And I had some losers that I just had to admit, I didn't know what I was doing. And that was in the early days of trading, and we all go through that to some extent. So yeah, I understand exactly what you're doing. I've got to work on the longer term hold. My wife and I disagree on this. She's like, just buy blah, 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 and put a 20% stop on it and forget about it. I'm like, I can't do that. So, but at any rate, but yeah, that's cool. That's cool. And anyway, whatever. I'll shut up. I'm mumbling now.
when it comes to averaging down, I was always taught, don't average into a loser. And that is tricky, because just because your trade is red doesn't mean it's losing. It may just be offering you a much better price, and it's a gift, right? So you're not trying to fix something that isn't working. You're taking a gift that they just gave you, and that's the way I like to see it. But if you're looking at a trade and you're like, oh my God, I'm getting murdered in this thing, what am I going to do? Oh, I'll average down so I can get out of it. That's a really, really bad idea. And I don't subscribe to that logic, because the one time I tried it, I lost an arm, a leg, a kidney, probably part of my lung, certainly left my butt back there somewhere too. And it hurt really bad. So I don't average into losers, but I will most definitely average into a position that I like at a lower price, because they're just giving me a gift. The trick is, or the problem, I should say, is how do we define a trade that's losing from a trade that's just not profitable, right? To where we can say, sure, I'm going to average at this point. Well, it would be, how do you feel about the trade? At least I used to think that, but I've talked to traders, they always have sentiment, and the sentiment can get you all screwed up. So if you're a scary kind of person that you're always scared of your trades, it's never going to feel good because you're scared all the time. That's not going to be helpful for you. So you're going to want to define some rules and some logic for yourself of what is a good trade and is it still good? How far did it fall and do you still think it's good? And then how much farther did it fall and do you still think it's good? For me, I don't have a dollar value. It's just, is it still a good trade? I know what a good trade is for me. I don't know what a good trade is for you. So once you can answer that, averaging down will be a lot safer because you definitely don't want to average down into a loser.
Yeah. No, I mean, I've had several situations where I've averaged down, and then, when I thought it was going to turn or something like that, it was speculative or whatever. For the most part, I think you remember I had that one bad trade with DraftKings some time ago, though. I think that was really my only bad trade that I had last year. And as far as dramatic, sure, I've had some 1-2% losers because at that point I start looking at it and saying, I cut it. If I don't like the chart after I'm in the trade, I start looking for an exit. But
I shared a picture in the chat. It was a tweet from Spot Gamma, or no, from TrendSpider this morning, and it was from Robinhood, and it said, if you loved it at 108 times earnings, you'll be thrilled to find it at 33x earnings. And I love that because there's always those value traders out there that are like, oh, I'm buying this piece of trash company because it's got a really great X value to earnings. And it's like, that's a piece of junk, right? Why you buy that? Oh, it's got such a great valuation. Ah, and it's trash. It's absolute trash. And then you'll get someone who's buying something at all-time highs, and they won't even look at, its earnings. This is the picture that I shared in the chat. I don't trade this way, and I know there's people who do, but I don't. Right? This is not what I do. But I thought it was
not when I
funny.
see that volume level way down there. Good God.
I know, right? They were dumping that thing. That's institutional exodus. Forced selling right there, baby. It's crazy.
Well, I mean, there's still a lot of people that enjoy fundamentals and like fundamental trading. I don't think it's near as effective as it used to be. I say that simply because I really just don't hear a lot of people talk about fundamentals anymore.
Well,
Um,
everybody's a growth trader now. Apple, Amazon, Google, Microsoft, they're all growth, not value.
yeah, yeah. But there's, um, you know, everybody's got a different way they look at it and what they like. And as long as it's in line with your expectations, maybe you're a dividender. I've certainly been looking at a lot of dividend angles for this 2025 year that, we have such mixed feelings on how it's going to turn out. And so for some of my long-term monies, I thought, well, maybe I should just park my butt over in dividends and wait it out and do my wheel trades and whatever else for my income. And, but everybody's got a different, what they like, what's acceptable and stuff like that. And we all have to find what works for us. And we also have different, we've got some young people in here and, they had that formula for years and years. What was it? 100 minus your age is, what percentage of equities you should be in and all that kind of stuff. And, or something like that. So a lot of it depends on your situation. How much money do you make a year? At your job or whatever. That affects a lot of things. How much money do you have left over? And are you able to save and so on? So everybody's in a different situation, sure. It's one of the beauties of the Bullish Bears is we've got different people, like Signet, you're able to talk on many different levels. And then you've got swing traders and we've got swing traders, we've got options traders and stuff. I love the variety that we have here.
If we use the worst case scenario of 27%, we're looking at an S&P dropping down somewhere around $450 a share.
Where did 27 come from? I forget.
The Reaganomics. So the last time we went to an economy that was based off of private equity rather than government subsidy was during the Reagan era. And when he enacted that, we seen a market have to flush out all of that government money and took the markets down 27% before he finally got it all washed out. Now, how much do we have to go before we wash it out? How far can we go before the current administration runs out of time? And will those be the same number? You know what I mean? Like we're not guaranteed to go that low. We're not even guaranteed to get to the end of this before we run out of time and
Well,
a new administration comes in.
but we've also got a lot of changes in policies and rules on the markets between Dodd-Frank and all that kind of stuff too has happened since Reagan. So I don't know that 27 would be the same number. I might cut it in half and say 14, maybe 15%.
Those regulations
Uh,
aren't going to stop the washing that we need. We need to wash the Fed out of the market. All of their bond purchases, all of their stimulus, all of their QE. You know what I mean? The regulations aren't going to stop that. Dodd-Frank ain't going to stop that. That's
all
banking
right.
regulations. We got Fed
There's you an
regulations.
AI question then.
Yeah,
How much will the markets change? First of all, you have to determine how much Fed money's got to get washed out. Then AI can say, okay, based on that, it's a certain percentage of the markets. If that gets 90% washed out, the markets will adjust to X.
right. And there are some tools on Thinkorswim on TradingView that you can use, but they're complex tools like Federal Reserve net liquidity. This chart here, it's a bit complex looking. You know, and you'd have to feed it to AI to even get a good description of what this chart is looking at. But I have charts like this that's tracking government liquidity and how that liquidity impacts the S&P. I've got correlated charts with the S&P laid over the top of it showing, you know, when this ratio reaches X level, the S&P bleeds X amount. Like it's a doable thing. It's just not an easy thing to do, but it's doable and it's really doable on TradingView because they have the Fed funds charts to do it with. And I've got a lot of
Well,
them.
I don't know. Is Copilot can read a chart, a graphic.
Yeah.
You might be able to, instead of having to build a spreadsheet or something, you might be able to do it just by giving it the graph. And you have to explain the graph. Left what the x-axis, y-axis is, what color this colored line means, such and such. But you might be able to just, like I say, dump the graph onto Copilot. I don't think you can do it with ChatGPT. I don't know about Grok.
I know that I can give Grok, I can just copy this code and I can give it to Grok and say, tell me what this chart is. And it'll tell me. And then after it tells me, I can ask it, okay, now I want to correlate that against the S&P. How would I do it? And it'll tell me. Like this is broker and dealer securities, basically margin. So I can keep track of how much margin the big dogs are using and whether it's increasing or decreasing and how their margin is being impacted by the moves in the S&P and the Nasdaq. So, you know, useful, but isolated, very specific, nuanced. Broker dealer funds. This is security brokers and dealers margin accounts, broker dealer level assets. You know, it's kind of like the chart we were just looking at, just a little bit different. So if I'm looking for a liquidity crisis, if I think they're going to get a margin call on the banks, I can monitor that and see, did it happen? You know, are they dumping their gold or something like that? All right, so we got a question in the chat. Heard both sides going into a position big and scale out, or start small and scale in, adding more? It's a really good question. It depends on a lot of factors. So let's kind of walk through some of those factors and why, where, and when, right? There's so many types of traders that we can't say that it's about which one is better. It's about which one suits the kind of trading that we're about to do. If you're talking about a day trade versus a swing trade, stocks versus options, futures versus bonds, or some kind of commodity, it would really have to come into effect, because which one of those do you want, right? And then what's the plan for the trade? If we go to something like the S&P, what's my trade? Yesterday's bounce, right? If it's one of my 111s, for an example, I would like to start big and scale out if I'm going to be in the trade for a small amount of time. If I'm going to catch it on the low and try to run it up to the high, I'd probably start small and scale in as I go. One of those, if you start big and scale out as you go, you're starting with a lot of risk right now, right at the beginning. And that's scary for people. Whereas if I start small and I let the move go into profit, and then I add after it's already in profit so deep that I can add more without putting the trade in the negative, then I never really get to see that big, scary negative number, right? But I have to have a move that continues to go. Otherwise, there's no room to add in. So if I'm looking at a trade that's going to last for 4 points, I got to start big and scale out, because I don't think I'll have the room to scale in as it goes. But if it's going to last for 35, 40 points and move across the chart, I can start small, keep the risk really low, and continue to add in when I can do it without adding risk or without going negative.
And I'll add to that too, to say a lot of it depends on time frame, as you know, tying into what Signet's saying about time frame. I've had a lot of false starts in my long-term accounts. And what I mean by that is, excuse me, is that, you know, I'll start a position, and let's just look at it two ways. One is it goes up in value. Well, if it goes up in value, on every little pullback, I may add to it and continue adding to it. Yes, I'm bringing up my cost basis, but I'm also increasing my overall position size. Excuse me. On the other hand, let's say it goes down. If I plan to hold it for a long period of time and I feel confident, as best that I can, that, you know, this is going to be a good year, 3-5 year trade, yeah, I don't have a problem adding to it as it goes down in the right spots, because then that lowers my cost basis. And but I said at the beginning of this, I had a lot of false starts. And that's really the third category, where I'll start with a starter position and I watch it. And if it doesn't move, if it doesn't this, if it doesn't that, you know, if it starts to, you know, if I start to start a position, I'm not going to take more than a 5% loss on it. Means that's not because of the markets, because it means me. I called it wrong. So 5% is my starter position risk. And usually, I mean, you have to look at the chart and adjust it a little bit, kind of thing. Sometimes I will start it, put it on the board with a 5%, and then I look at it and says, oh, I don't need to put 5% risk on here, and I'll move my stop up, and it ends up only being 3%. Other times, maybe it goes down to 6%, but around 5. Anyway, if it sinks, okay, I called it wrong, and I'm out. But other times I see it'll go up 3, 4, 5%. And then I start to see it rolling over. And I say, well, I don't like this rollover here. I'm going to move my stop to break even, because I don't want to lose. Or if it gets up to 10%, I'm going to lock in 5% in the very beginning. But if it clears that 5% and just keeps on going up over time, then yeah, now I'm in it. That's the way my thinking process works on this. Have I had a lot of success with it? I've had a lot of false starts because I just started this last year in 2024. And, I have not been doing a lot of long term holdings. I didn't have a lot of long term holding experience. So I wasn't quite 100% sure what I was doing. But at any rate, this year, unfortunately, now that I've got a little bit more experience, we've got these very low expectations. I'm like, well, shoot. But yeah, I very, like Signet said, if you're planning on a very short hop and a skip and a jump kind of real quick move, yeah, I could see taking a bigger position. But that's no different than day trading on the futures. If you're going for 4 points, you might risk 2 points. But if you're going for a 5-to-1 reward to risk kind of thing, yeah, you can scale in or whatever else you want to.
Yeah,
But just be mindful of the amount that you allocate of your total portfolio. Just be mindful of the amount that you're willing to risk. Remember when we say that maybe putting on 3% does not 3% is where your stop goes. It's not saying that you can't take a trade that's 10% of your account. That's not what that rule means. It means that your stop is at 3% of your account, and or whatever your risk tolerance is.
Size definitely has something to do with it too. If, for an example, some traders use a fixed dollar value that they don't want to go beyond when it comes to loss. They'll say, my loss is set at, let's just say $500. So you don't want to lose more than $500 in a trade. And that means you can start the trade with 10 shares with a $500 stop, or you can start the trade with 20 shares and use $1,000 stop. Right. Well, you look at that and you say, no, $1,000, that's too much. All right. Well, then you have to go back to the smaller amount. But what if I don't use 10 shares? What if I end up only using 5 shares? Well, now I've decreased my stop size. So you can play the math with that too and look at your attempted trade before you put it on and ask, if I start small, can I use a fixed dollar loss or a stop that fits my parameters? And when I do, where does that put my stop? I drew 2 boxes on the screen. One box would get hit. If I had my stop at the top of this box, that wick reversal would have took me out. It was a $2 stop and it was not big enough. This other box was a $3 stop and the wick didn't hit the top of the box. I would have survived that trade. Both of those had the same entry, just one had a bigger stop. Now, if I reduce my position size, maybe I can use a bigger stop, right? Or vice versa. So you can try to do that math too. If you're unfamiliar with which way you want to go, or if you're just not sure and you want to experiment, it's not a bad way to go to try to look at it from, well, what's my risk settings? I noticed in the chat you did like the idea of fear being a motivator, because it is. A lot of us are more willing to hold a trade as long as the trade isn't giving us any pain. So if you start small and it goes green and then travels far enough that you can add another and it doesn't make you red, and then it continues to travel and you can add another and it doesn't make you red, then you can slowly build out your trade without ever having that paranoid, really big risk loss weighing on your mind and on your shoulders. It's a good way to go if it behaves well, it actually moves in your intended direction, but scaling in is a difficult thing to do. And when I really struggled with it was with futures. A lot of the chat that we see and a lot of the trading that I've seen is traders going for very small moves. And there's no room to scale in if you're only going to take a very small move. So it's just impossible. But when I approach futures trading, I don't approach it from a scalp point of view where I'm in and out in 2 points. I try to focus on, when I can, getting something with some duration behind it, something that's going to last a little while. And when we get those, it's fantastic. I'll absolutely take it. run them from one side to the other when possible. And with those, I don't like to start big. I like to start small because I know if I'm going to run a chart from one side to the other, it's usually going to have a really big pullback. Usually. So here's one good example right here. If we were shorting this, we had a good short when it started, but then it pulled back 25 points. 25 points. No way I would handle that pullback in a responsible way if I was heavy in size with that big of a pullback. It would just freak me out. So I usually keep my position small if I plan to run all day. But once it's outrun me, if say I got in up here at 6,000 and it's bouncing somewhere down around 62, it rejects at 80 and breaks 62 and continues to go lower, I'm feeling pretty good. I'm probably going to add to this at this point because now I've got this major level of resistance that we broke through that will, well, it was support, now it'd be resistance that would hopefully protect my position. And I'll add now because I'm feeling really good and I've got such a distance between where I got in and where it is now. So adding in can be really dynamic. You can let the chart tell you it's time to add in. It's just frustrating because if you've never had a trade like this, if you're hearing me talk and you're like, what, 110 point move in the S&P? I've never had one. Well, then you don't have to worry about adding in because you haven't had the opportunity to even do it yet. Catch a couple of those, and then you'll have the argument of, I really need to figure out how to add in because that was a fantastic move. Yeah, absolutely. Learn to add in on that because that's great. But if your move is in that candle and it's done in less than 5 minutes and you were in and out in 6 points, there's not a lot of room. It's not to say that you can't do it, but
Well, you can always use a runner at break even.
Yep.
I do a runners a lot of times. Now, you have to understand that 95% of the time, the runner gets stopped out at break even on a successful trade. The downside to a runner is if you're initially wrong completely, and you take a full loss, you take a full loss of the runner as well. So it's kind of risky sometimes using a runner unless you really feel confident about the move, at least to a point that the runner can get to break even. But that way, the runner doesn't necessarily have to have any objective targeted at all. You can just let it run all day if you want to. But that, because that's just an extra.
There's a question in the chat about the 2-point stop. That 2-point stop that I use, I trade the NASDAQ in the pre-market. And I do that because generally the pre-market is so slow that the NASDAQ's movement makes it beneficial. We're not in that environment. We're not in a normal environment. So even in the pre-market, the NASDAQ, the S&P, everything's moving big. But generally, my 2-point stop is done in the pre-market on the NASDAQ. Since things are violent lately, I've been trading the ES in the pre-market because I don't need the NASDAQ in the pre-market, right? Like normally we do, but not in this environment. So I'm using the ES in the pre-market simply because there's so much movement. But that 2-point stop does not work for me in the middle of the day. When I do try to use it in the middle of the day, I do it after lunch and I get into a smaller chart time frame, something like a 750 tick or a 1200 tick. That helps. These time-based candles are worthless for using a small stop, right? The stop size has to match the candles that you can read. And if your intraday candle, or heck, even in pre-market, if your candle is 10, 12, 15 points wide, then you're on too big of a time frame. You have to go to a smaller time frame. This is a 5-minute, and these are big candles. So I can look at that's CPI. I can look at these big candles and say, well, they're too big. It's 5-minute. I'll go to a 1-minute. If you look at a 1-minute and you're still looking at really big candles, you're going to have to go to a smaller time frame. You need candles that match your stop size. So you have to have something that you can read. If there's nothing there to read but one big fat candle, then it's impossible. The analogy that I use is here's a daily chart. So this is a 1-day daily chart. Every candle is 1 day. And as you can imagine, these are really big bars, right? Because it's a daily, it's huge. That really big bar probably has really good price action in it, right? Like just absolutely amazing trend quality price action that I could trade, but I can't see it because all I've got is this really big fat bar. Well, that's worthless. I can't do any good trading with this. I would need a huge stop just to avoid price. So the day is too big. I guess I'll go to an hour. Golly gee, look at the size of that candle. That thing is huge. Absolutely worthless. I can't see anything. I have no price action to go from. It would wick me out in a moment's notice. All right, well, that's too big. What do you got? 15 minutes. Well, the current candle ain't too bad, but on average, these are some pretty big candles. This is way too big. Absolutely no value. You kind of see it, right? It's a simple answer, but only because it's so simple, we don't see it. If the size of your candles are so big that you have nothing there to read, you can't read it, it's going to stop you out. So if you want to use a smaller stop, you have to use a smaller chart. Now, trust me when I say I'm no Jeremy. I don't want a 10-second chart. I don't want a 30-second chart, which is why when I'm trading and I want a smaller chart, I go over to Tradevate or I go look at Thinkorswim while I'm trading because they have tick charts, not seconds charts. It may be nuanced or different, but a 30-second chart or a 10-second chart is not the same as a 750 tick or a 1200 tick chart. They're completely different. You need to have something that you can read so that you can define support, resistance, momentum, trend, and breakouts. And if all you have are those big fat candles, then you don't have anything to read and you're going to get stopped out with your really tight stop. It sounds simple when I say it, but it's trickier than heck, right? Because you still have to get used to doing it. But for an example, this is a 750 tick chart. And if I zoom in here, you can see where there was this really tight consolidation period and a really nice breakout period. A smaller, tight consolidation period and a breakout period. If I'm looking for trading opportunities and I want to go swiftly with a very tight stop, this is exactly how I do it. Now, maybe that's a bit Jeremy. I know we're just labeling him a little bit, but he's good at it, right? He's earned the title. We're picking on him a little bit, but I can't do what he does. That's his realm. When I want to go smaller, I go to a tick chart. And when I want my tight 2-point stop, this is how I do it. The problem in the current environment is, even for me, using a 2-point stop all the time is not possible. You have to be willing to accept that the current market environment is just too violent and you can't use it. Or you have to be willing to accept Jeremy's level and go all the way down to a much too small of a time frame. So this is where volatility math comes in. I normally use 4 contracts and a 2-point stop. If I'm going to use a wider stop, say a 4-point stop, then I'll use a 2 contracts. The math is the same. My risk is the same. My loss is the same. And my profit targets increase, right? So instead of going 2-point stop for a 10-point trade, I'll use a 4-point stop for a 20-point trade. If volatility has increased, then I will reach my 20 points. In a lower volatility environment, I'll stick with my 10, but I'll have my 2-point stop. So it works out either way. The frustration comes for traders that are only using 1 contract because then you can't scale, right? And you just have to be willing to accept a bigger loss. I'm not necessarily willing to do that. But now that you know the trick, you have to find a time frame that works for you. And there's no magic to the tick chart number that I use. What I'm looking for is a candle pattern that I can read. And if I get the chart too small, it turns to trash and I can't read it. So you have to find a time frame that meets those qualifications. It's not too small that you can't read it anymore, and it's not too big that your stop is just going to get wicked out. What's the magic number? Unfortunately, nobody else can tell you what your magic number is. But here's a tip. When I first messed with a tick chart, I was trying to replicate a 5-minute chart. What a waste of time. Somebody finally told me something that was so obvious I should have seen it all along. If you want a 5-minute chart, go look at a 5-minute chart. You don't have to spend your effort to recreate it. You already have it. Just go look at that. I don't know why I didn't see that for myself, but the trees in the forest, I didn't see it. So don't try to mimic what you have somewhere else. Just put it on a known time frame like 1000 tick and go in and scroll. And remember, one day isn't going to give you an answer. Because today, for an example, we had, some price action that was completely different than what we had last week. So look at it and ask, do I have opportunities to trade here? Can I read this price? Is it too small? And if it's not too small, try to go a little smaller. If it's too small and you're looking at it and you just feel like there's nothing there for you, it's too small. Go up some. Let that be your guide. And then to get better, because we all want to use a smaller stop, if it is forcing you to use a bigger number, use a stop that meets that time frame. You can use ATR or some kind of math like that if you have to. You can go to paper and just paper trade it with different size stops to get a number that way, whichever way works. But the goal would be to slowly over time get better at reading a smaller chart so that you can get the opportunity to use a smaller stop. They're really good trades. I don't even have to do all that, right? Like yesterday's low, yesterday's 111 that we had yesterday, for an example. What a fantastic play. It just works out. It's a really good chart, really good setup, really good trade, and I don't have to mess around with it. They're not always that great. Take them when we can get them, though. I think we got a lot done today. Hopefully, I give you guys food for thought on this market backdrop that we're in and why I don't think we're going to solve the problem anytime soon. And at the bare minimum, if I can just save you guys from trying to buy the dip, thinking that we're going to rally out of this really fast, then I feel like we got a lot done. Don't be surprised, though, if we rally up to like 590, maybe even 600. We could overshoot that because if they fund the government by Friday, we're going to get bullish. We get some positive news, maybe some tariff talk. The war in Ukraine might get resolved. We could get some good bullish pops, but it's not done. And as long as those tariffs are degrading investor confidence and money still leaving the U.S., then we're not coming back up to those levels yet. I think that summarized it really well. So that's what I got, guys. Unless you have any questions. All right. I will see y'all in the morning briefing.